On July 17th, China's National Bureau of Statistics released the country's economic data for the first half of the year. The gross domestic product, or GDP, reached 59.3 trillion yuan, with a year-over-year increase of 5.5% at constant prices. The release of this data resulted in varied reactions. Chinese citizens felt a significant disparity between this figure and their intuitive understanding of the national economy. Some professionals within China's economic sector expressed skepticism about these numbers, while international economists generally perceived this growth as overstated due to the lower base during the same period last year. They believe the Chinese economy is falling into stagnation, even regressing, maintaining a pessimistic outlook towards China's economic future. The Chinese Communist Party's manipulation of statistical data has long been criticized, particularly concerning GDP figures, which are often suspected to be inflated. The Chinese economy did experience a brief rebound when pandemic restrictions were lifted last year, but quickly fell into decline. Swiftly decreasing export orders, harbors filled with empty containers, a significant number of factories going bankrupt leading to a wave of unemployment, a sluggish real estate market resulting in reduced investments, dismal brick-and-mortar store businesses, falling consumer spending, and even the potential of a fiscal crisis due to reduced local government income all contribute to an indisputable reality. Consequently, some netizens have suggested that the three driving forces of China's economic growth, that being domestic demand, investment, and import-export, have all stalled. In such circumstances, a 5.5% GDP growth seems quite unbelievable. As for local government officials, they have a long-established trend of overstating economic data to secure achievements and promotions. So, what is the real figure for China's economy? Let's delve into expert analysis. A China-based big data expert who goes by the pseudonym Lao Man, currently residing in Hong Kong, wrote that the economic downturn in China for the first half of the year is glaringly apparent. Where does this supposed positive GDP growth come from? A significant negative growth seems more likely. After analyzing China's tax revenue data, Lao Man disputed the claim of a 5.5% GDP growth for the first half of the year, suggesting it's more likely a shrinkage of about 5%. Lao Man stated that the first half-year tax revenue analysis released by China's Ministry of Finance revealed a unique circumstance. The value-added tax, or VAT, increased by 96%, primarily due to measures like carryover tax deductions implemented last year, which were to be compensated this year. Therefore, excluding the impact of VAT and only considering other types of tax income, the tax revenue for the first half of the year was 6.21 trillion yuan, compared to 6.64 trillion yuan for the same period in 2022, when VAT was deducted. This implies a decrease of 6.4% in China's other tax revenues this year. Lao Man concludes that this negative 6.4% is likely the actual scale of China's GDP contraction. Of course, this deduction is merely based on the decrease in tax revenue, and it might not seem particularly convincing. Let's further explore Lao Man's analysis of the three components of GDP: exports, investments, and consumption. The first component of GDP is net exports, that is, the trade surplus. China's merchandise trade surplus in the first half of this year was $408.7 billion, an increase of 6% from $385.5 billion in the first half of last year. However, China's service trade, including tourism and technical services, was negative, totaling negative $99.7 billion in the first half of the year. Therefore, the overall trade surplus for the first half of the year was $309 billion. Compared with $344.3 billion in the same period last year, this represents a decrease of 10.3%. The trade surplus acts as a lubricant and accelerator for China's economy, and its significant decline suggests the country's earning power is decreasing, indicating a loss of momentum in China's economy. Furthermore, as the strategy of decoupling from China is being implemented in the Western world, with supply chains gradually moving out of China and investments being withdrawn, it implies that net exports have no possibility of recovery. Instead, they will continue to shrink. Next, let's look at the second component of GDP, investments. The scale of fixed asset investment in the first half of this year was 24.31 trillion yuan, compared to 27.14 trillion in the same period last year, a decrease of 10.4%. Private investment, namely investment from private enterprises and individual households, totaled 12.86 trillion yuan in the first half of this year. Relative to the 15.31 trillion in the same period last year, it dropped by a striking 16%. This suggests a loss of confidence in the future among private sectors, leading to a significant contraction. At the same time, local governments burdened with heavy debts can't continue investing in infrastructure construction, hence losing their growth potential. The taxes currently collected by the government are barely enough to maintain basic governance. Infrastructure investment will require issuing more bonds. According to data from the central bank, the net financing amount of government bonds in the first half of this year was 3.38 trillion yuan, a contraction of 27.4% compared to 4.65 trillion in the same period last year. This is primarily because local governments can no longer bear additional debts. According to Shanghai-based financial data company Wind Information, 41% of cities nationwide are on the brink of a debt crisis, with most resorting to debt extensions to temporarily avoid a financial collapse. Investment is the cornerstone of China's economy and the most critical pillar supporting economic growth. With investment in a state of contraction, the Chinese economy will only follow suit. There's no other possibility. With both investments and net exports showing a decline, their combined total in the first half of this year was 26.48 trillion yuan, compared to 29.37 trillion in the first half of last year. This is a year-on-year decrease of 9.8%. Let's now turn to look at consumer data for the first half of this year. Given that consumption is inherently diverse and cannot be uniformly reported, we'll only compare the retail data of entities above a certain limit. This refers to retail businesses with an annual primary business income of above 5 million yuan, and accommodation and catering businesses above 2 million yuan. The data from these entities is directly reported to statistical departments for a comprehensive calculation. These data are more accurate compared to the total retail sales of consumer goods. In the first half of this year, the retail sales of entities above the limit reached 8.53 trillion yuan, a modest increase of 5.1% compared to 8.12 trillion last year. Considering the extensive lockdowns across the country in the first half of last year, particularly the second quarter shutdown in Shanghai, a slight increase in consumption this year is normal. However, this growth rate, already lower than the 5.5% GDP increase declared by the National Bureau of Statistics, certainly won't fill the nearly 10% gap caused by the contraction in net exports and investments. Indeed, the dismal business and even bankruptcy of many brick-and-mortar stores over time suggest that the situation for small and micro-retail enterprises is even more bleak. Large shopping centers are generally deserted. Consider a woman who runs a medium-sized supermarket. July used to be her peak season, but this year it's different. Even bottled drinks aren't selling in this hot weather.
Everyone knows that July is typically the busiest season for us supermarket owners. It's peak season. But what's happened to business this year? We can't sell water, ice pops, or beverages. So what can we sell? Look around. See anyone? Even the shop across the street that doesn't usually do much business, selling some baked buns, can't make sales today. Buns that cost just 2 yuan each, and there's no one buying.
According to Lauman's analysis, a more troubling issue is the clear downward trend in the growth rate of these entities' turnover. In the first quarter, the growth rate was 7.6%, but by the second quarter, retail sales only amounted to 4.16 trillion yuan, a year-on-year growth of just 2.5% compared to 4.06 trillion last year. The second point pertains to automobile sales data. The growth rate of car sales in the first half of this year was only 2.8%. Automobiles are the most important consumer goods, and their upstream and downstream industrial chains far exceed all other consumer goods. A slowdown in the growth of car sales naturally signifies a sluggish consumer market. Meanwhile, the sale of excavators, a key indicator of investment activity, continues to shrink sharply for the third consecutive year, with a contraction rate of 44% in the first half of this year, indirectly confirming the significant contraction in investment. In summary, both net exports and investment in China's economy showed significant contractions in the first half of this year, amounting to 9.8%. Consumption growth was only 5.1%. Given that the share of final consumption in China's GDP according to the expenditure approach is about 50%, and the share of net exports and investment combined is also about 50%, when considered together, China's GDP in the first half of this year couldn't possibly have grown. It could only have declined by about 5%. And judging by the current data trends, the situation will only worsen in the second half of the year. Lauman estimates the annual GDP contraction will be around 10%. Perhaps even the Chinese Communist Party's leaders don't believe the data published by the Statistics Bureau, and they also recognize the severity of the economic situation. On July 24th, Xi Jinping presided over a Politburo meeting to analyze and study the current economic situation and arrange the economic work for the second half of the year. The meeting unusually acknowledged that China's economy faces new difficulties and challenges, primarily insufficient domestic demand, operational difficulties for some enterprises, more risks and hidden dangers in key areas, and a complex and severe external environment. The impacts of insufficient consumer demand are also felt by companies that produce essential household goods. According to data from Kantar World Panel and Bain & Co. in China, the average selling price of skincare products, kitchen cleaners, yogurts, toothbrushes, and infant formula all declined in the first quarter of this year, compared to the same period last year. These two companies' research shows that the price of cosmetics sold in China earlier this year dropped by nearly 5% on average. Estee Lauder, owner of numerous high-end makeup brands, recently announced a decline in the sales of cosmetic products in mainland China. Studies also reveal that despite the lifting of pandemic restrictions and increased foot traffic in stores, consumer spending continues to decline. Reports by AFP suggest that this trend is largely due to many people still adhering to the frugal habits formed during the pandemic. In an attempt to alleviate the sluggish consumer climate, on July 21st, China's National Development and Reform Commission, or NDRC, released two documents aimed at boosting consumption of cars and electronics. This followed a joint release from 13 government departments promoting home-related consumption. At a press conference, Chang Tie-wei, deputy director of the Employment Department of the NDRC, claimed that in the first half of this year, final consumption expenditure contributed to 77.2% of economic growth, maintaining its position as the primary driver. The policy documents aimed at restoring and expanding consumption are comprehensive and will be officially released soon. However, we also observe that the current situation in China is one of economic decline and increasing unemployment. Layoffs and salary cuts among both companies and government officials have diminished the buying power of the middle class. Moreover, the lack of confidence in the future has made many people hesitant to consume. Therefore, in this context, any amount of stimulus measures released by the Chinese government may not have the desired effect. As for the risks in key areas mentioned by officials, analysts suggest that it essentially refers to the issue of debt default by real estate companies. Evergrande, a Chinese real estate giant listed in Hong Kong, recently released a 2-year delayed financial report stating a loss of 812 billion yuan over the past 2 years, with total liabilities amounting to 2.44 trillion yuan. Evergrande's total assets are approximately 1.84 trillion yuan, and net assets are around negative 600 billion yuan. This financial report has drawn significant market attention. Financial expert Zheng Xuguang analyzed that Evergrande may go bankrupt and liquidate, but its assets of 1.8 trillion yuan are a minefield. This is because Evergrande's assets are primarily inflated lands recorded on paper, which would plummet in value once liquidated. This could trigger a series of devaluations in the real estate market of second and third-tier cities, potentially causing issues for government financing platforms, affecting the banking system, and possibly even influencing the property evaluations of first and second-tier cities. The entire real estate industry is facing a storm. As Evergrande's crisis unfolds, the BBC reports that hundreds of real estate companies have experienced bond defaults, a breakdown of the capital chain, or even bankruptcy one after another, leading to a surge in unfinished building projects. At the same Politburo meeting, emphasis was placed on revitalizing the capital market and boosting investor confidence. There was a call for a continued deepening of reform and opening up, effectively optimizing the environment for the development of private enterprises. In order to stimulate the economy, Beijing authorities have recently rolled out several policies and explicitly stated their support for the primary source of China's economic vitality, the private enterprises. On July 19th, the State Council announced 31 guidelines to promote the development and expansion of the private sector, intending to boost the confidence of private enterprises and encourage privatization. At the central level, 11 policy documents were issued in one day, claiming to assist the development of private enterprises. This is rare in the recent history of China's economic policy releases, but it also highlights the lack of confidence and sluggish recovery of the Chinese private sector. On July 20th, during a press conference at the State Council Information Office, Deputy Director of the National Development and Reform Commission, Li Chunlin, announced that they would soon introduce relevant supporting policy measures. These included a series of short-term measures to promote the development of the private economy, and the drafting and issuing of policies to encourage and stimulate enthusiasm in private investment. These 2 documents will be issued soon. Worth noting is that on July 20th, the 3 major indices of the Chinese stock market fell, contradicting the official media's promotion of the heavyweight documents supporting the private economy, showing the investors' pessimism towards this. On July 24th, the National Development and Reform Commission announced measures to promote, encourage, and stimulate private investment in certain infrastructure sectors, and stated they would enhance financing support for private projects. However, there are doubts about the series of measures claimed by the CCP government to support the development of private enterprises. According to a report by Radio Free Asia, Hu Lirun, a former private entrepreneur from Florida, after reading the main document, stated that the Beijing authorities could not practically implement these policies. It might be the case that if you have good relations with the government, some policies could be implemented, but it's still the old path. When I was running a business in China, many people needed government relations, needed to bribe officials, and you could possibly get some policies going for you. Although Hu Lirun has left China, he has maintained close contact with the Chinese entrepreneurial community. From his observations, his entrepreneur friends in China are not in a good state. He also mentioned that there might still be a few industries, including pharmaceutical companies and metal processing companies related to automobiles, that have a good market. However, in the face of the downward trend of China's economy, Hu Lirun maintains a pessimistic outlook for the future of private entrepreneurs. The CCP meeting also mentioned that the external environment is complicated and severe. This mainly refers to changes in geopolitics, the shifting of orders and supply chains overseas, which directly impacts China's export trade. the latter half of the year is unlikely to improve. Therefore, many commentators believe that there is no visible hope or bright spots for China's economy in the second half of the year, and it could possibly worsen.